Okay, so you're faced with these complex financial reports, right? Piles of numbers, jargon.
hmm
How do you actually figure out what's important without getting totally lost? It's exactly what we're tackling today. We're diving deep into Shopper Stop's latest results. That's Q1 for their fiscal year 26. Our mission, to cut through the noise and pull out the key insights. We want to understand how this big Indian retailer is really doing, what strategies are clicking, and maybe get a glimpse of what's next. We'll try and keep it interesting, maybe find a few surprises along the way.
Exactly. And to do that, we've got the main documents right here, the official press release, their investor presentation, and the notes from the board meeting for the quarter ending June 30th, 2025. The idea is to, navigate all this info and give you, the listener, a really clear and hopefully useful take on what actually matters in these results.
All right, let's jump in. The big picture first. Headline numbers for Shoppers Stop, Q1 FY26. Sales first, they reported Rs 1,094 crore using GAAP. And then there's a non-GAAP figure of Rs 1,336 crore. Both of those are showing a 6% growth compared to last year. Pretty steady. Now that GAAP versus non-GAAP thing,
Yeah.
I mean, just a quick refresher.
Sure. So GAAP, generally accepted accounting principles, that's the standard way everyone reports. It follows strict rules. Non-GAAP companies use that to show performance without certain things that might distort the picture, like, say, a one-off restructuring cost or certain accounting rules about depreciation. It's meant to show the underlying operational performance more clearly.
Got it. Okay, so how about profitability? EBITDA.
Right. EBITDA earnings before interest, taxes, depreciation, and amortization. Here it gets interesting. GAAP EBITDA was Rs 176 crore. That's up a solid 21% year over year. But the non-GAAP EBITDA, that was Rs 26 crore, which is a massive 68% jump from last year. That really points towards some serious improvements in how efficiently they're running things.
Wow, 68%. That's quite a leap. What's behind that kind of operational efficiency? What's driving the growth overall?
A big part of the story is their focus on premiumization. They've been pushing this strategy hard. And you can see it working. Premium products now make up 67% of their sales. That's up 8% compared to last year. It suggests, that customers are definitely willing to spend a bit more for higher-end goods, and Shoppers Stop is tapping into that.
And you can actually see that filtering down into the nitty-gritty operational numbers, right? The KPIs, like average transaction value ATV that went up 6%, hitting Rs 5,169. Average selling price, or ASP, also climbed 3% to Rs 1,740. And even the items per ticket, the IPT, increased by 3% to almost 3 items. So people are buying more, and they're buying more expensive things each time they shop.
Precisely. It's not just one metric. They're all moving in the same direction, supporting that premiumization narrative. And another interesting point, the contribution from their personal shoppers, that jumped quite significantly, from 18% to 25%.
Oh, wow. So that personalized service is really driving higher value sales then.
It certainly looks that way. But despite all this positive operational stuff, the bottom line, the net profit, well, that showed a loss. It was a net loss of Rs 18 crore under GAAP and Rs 7 crore under non-GAAP.
Okay. So strong operations, but a net loss. How does that square up?
Well, the key thing here, especially for the GAAP number, is the impact of new stores. They're investing in expansion. And under the accounting standard in AS 116, which deals with leases opening new stores, means you recognize higher depreciation and finance costs up front. So while the stores might be performing well operationally, the accounting treatment for the leases hits the profit before tax and consequently the net profit, particularly in the initial phase. It's more about accounting rules than, say, poor performance.
Okay, that makes sense. And investment cost,
Yeah.
essentially hitting the books now. So beyond those headline figures, let's dig a bit deeper. What are the key strategic areas, the pillars driving things?
Right. First up has to be their loyalty program, First Citizen. It's frankly massive. It contributed 85% of their total sales this quarter. That's
Yeah.
huge.
85%. That's incredible loyalty.
It really is. And break that down. 70% of that came from existing repeat customers. Customer retention is clearly very strong. And 15% came from new members signing up. So they're still growing the base, too.
And the numbers for the premium tiers are pretty impressive, too. They hit an all-time high for their Black Cards, 31,000 of them, which is up 68% year over year, plus 195,000 new Silver Cards in just the quarter. And those premium Black Card members, they alone contributed 19% of total sales. That contribution itself grew 44% year over year.
Yeah, the engagement is clearly there. They mentioned specific initiatives too, like First Citizen Select Days and their big India Wegs with Shopper Stop campaign. That wedding campaign alone brought in ours 154 crores in sales, a 46% increase. So targeted campaigns on top of the core loyalty are working well.
Okay, what about the beauty segment? That's always a big focus for them.
Yes, beauty is crucial. We need to split it a bit though. If you look at beauty sales just from their own stores, excluding their distribution business, that was Rs 219 crore, up about 2% year over year. But if you include their beauty distribution arm, Global SS Beauty Brands, the total beauty sale jumped to Rs 284 crore. And that figure is up a healthy 17% year over year.
All right, so the distribution side is really adding some momentum there. Any particular highlights in beauty? New brands?
Definitely. They brought in some pretty big names, Dolce and Gabbana, Lovatisi, Giordano, Elisab, adding to that premium feel. But the standout really is that distribution business, Global SS Beauty Brands Limited. Sales that were as Rs 84 crore, that's up 117% year over year.
Wow, 117%. What's driving that?
They expanded their distribution for Armani Beauty. They also launched Messi the fragrance exclusively in India. That probably got some attention. And interestingly, they've partnered with Swiggy Instamart, getting beauty products onto quick commerce platforms. That's a smart move, tapping into convenience.
Very interesting. Okay, shifting to their own labels, private brands. How do they do that?
Private brands brought in Rs 156 crore. That works up to 13% of total sales, but importantly, 18% of their apparel sales. These brands usually offer better margins, so that's key.
And are they growing? Is volume picking up?
Yeah, good volume growth in apparel, up 18%. They specifically called out kids' wear, which grew 33%, and women's western wear, up 24%. Some specific brands did really well. Fratini was up 41% in women's western and 12% in men's. Kashish in women's Indian wear grew 15%. So yeah, the in-house brands seem to be resonating.
Now, there's another piece here, Eintune. This seems like a faster growing, maybe more value-focused part of their business.
That's right. Eintune is definitely an emerging growth engine for them. Sales doubled compared to last year, hitting R68 crore.
Doubled. Okay. And are they expanding its footprint?
Rapidly. They opened 4 new Eintune stores just this quarter. That brings the total to 75 stores spread across 33 cities now. And they're seeing decent customer loyalty build even in this newer format, a 32% repeat rate in their like-for-like stores. They also just launched infant wear within Eintune, broadening the range.
And that expansion costs money. I saw they mentioned capital expenditure.
Yep, Rs 21 crore in CapEx for the quarter. And they said most of that was directed towards opening those new Eintune stores. Shows where their investment focus is right now.
So overall, what's the total store network look like now?
Across all their formats, the main department stores, the specialty beauty stores, Eintune, and others, they have 299 stores in 70 cities. It covers about 4.5 million square feet of retail space. It's a substantial physical presence.
Okay, let's zoom out a bit. How does all this fit into the wider retail picture? What's happening in the market, and how shoppers stop adapting?
Well, the broader market context is a bit mixed. We're seeing reports of higher store closures for some other retailers, maybe suggesting some overexpansion or shifts in consumer habits in certain areas. But Shopper Stop seems to be doubling down on its strategy: curation, connection, and convenience. They're also leaning heavily on technology for personalization. An interesting side note from the market is that watches continue to perform really well, kind of an outlier category. And global beauty brands are definitely keen on getting premium shelf space in India. The demand is there.
And there were some positive tailwinds too, right? Better foot traffic.
Yeah, footfalls improved compared to the previous quarter, helped by the wedding season, and perhaps slightly lower inflation taking some pressure off wallets. Although growth did moderate a bit in the pure value retail segment, which kind of reinforces Shopper Stop's push towards premium.
What about the view from the top? What did the management, the CEO, have to say?
Mr. Kavindra Mishra, the MD and CEO, really hammered home the commitment to premiumization. He explicitly stated the goal is to get that premium share up to 70% by the end of this fiscal year, FY26.
That's an ambitious target. So how do they plan to get there? What are the priorities?
They laid out a few key things: optimizing inventory, making sure they have the right stock, building on their own brand initiatives like that India Weds platform to drive growth spurts. Also, allocating capital smartly to the categories and stores that are growing fastest, maintaining that high loyalty program contribution, keeping it above 80%, and of course, continuing to invest in digital transformation. It sounds like a focused plan.
Okay, nearly there. Anything else we need to cover? Financial nuances? Board changes?
Yes, two important points. First, the auditors included what's called an emphasis of matter in the report. It relates to a potential service tax liability from way back 2007 to 2010. It's about Rs 20 crore consolidated. The company hasn't set aside money for it because they're appealing it in the Supreme Court. The auditors aren't saying the accounts are wrong, but they're flagging this unresolved legal issue as something significant users of the accounts should be aware of. Importantly, though, their overall audit opinion was unmodified, meaning they still find the financial statements present a true and fair view otherwise.
Right, so a flag but not a qualification of the accounts. Good to know. And the board changes.
Yes, quite significant. Mr. B.S. Nagesh, who's been with the company for, 34 years and was chairman, retired on July 17th, 2025. A real end of an era. Mr. Nirvik Singh has been appointed as the new chairman, starting July 18th. The company paid a really warm tribute to Mr. Nagesh, mentioning his bold but measured decisions, commitment to good governance, and his ability to build consensus. It's a major leadership transition.
Definitely a big moment for the company. Okay, so let's wrap this up. After diving through all that, what are the key takeaways for someone trying to understand Shopper's stuff right now?
I think the main things are, one, their strategy of focusing on premiumization is clearly yielding results, driving both sales mix and those operational KPIs like ATV and ASP. Two, their First Citizen loyalty program is incredibly powerful, locking in a huge portion of their sales and engagement. And three, despite some net loss figures due to accounting for expansion, the underlying operational growth, particularly in non-GAAP EBITDA and in key segments like beauty distribution and Eintune, looks pretty robust. They seem resilient.
So here's a final thought to leave you with. We see this strong push towards premiumization, but at the same time, their Eintune format is doubling sales, likely tapping into a more value-conscious segment. And they're partnering with quick commerce like Swiggy Instamart for beauty. How does a retailer like Shoppers Stop ultimately balance that high-end premium strategy with the clear opportunities in faster-growing, possibly more value-driven segments or channels? What kind of tensions or perhaps new opportunities could that balancing act create for them in the next few years? Something to think about.